I'd like to give you my views on today's new metals bull market. I'm going to go over why it's here and how you can profit from it. So let's get started. As everybody knows, or knows from my previous presentations during this pandemic, I believe that the COVID-19 pandemic was the pin that pricked a massive existing bubble. It was a good excuse, but it was simply the excuse du jour for a correction that was going to happen at some point anyway. And when that happened, when there was some slowdown in the economy or some kind of a hissy fit in the markets, the Fed was going to react in a greater fashion, a more urgent fashion than it had post the 2008 great financial crisis. But even I was amazed, although I expected everything the Fed has done, I was amazed at the policy response, both from the Fed and fiscally from the government. It's actually been extraordinary, and it's dwarfed anything we've ever seen before. Here's an illustration of that in a chart of total Fed assets. As you can see, and by the way, these charts come from the chartstore.com, does most of the charts that I use in Gold newsletter. It's a great service that I highly recommend. And as you can see in this chart, the Fed actually returned to asset purchases or some form of quantitative easing a little less than a year ago, late August last year. And they started that for a while from then into this year, well into this year, into March, buying assets and saying it wasn't quantitative easing because they weren't buying across the entire yield curve. But then, as you can see, here comes the pandemic, here comes COVID, and it's just a rocket shot upward. Now, there is a bit of a downward jog here. That is no change, represents no change in policy from the Fed. That's purely some of these swap agreements being repurchased or paid off. It's more of a technical thing. Is some of these programs that they set out for dollar swaps and the like were paid off and or canceled. So the net effect, the program is still in effect. They are still printing money. Now, the Fed's QE program this time is, as I said, dwarfed anything ever seen before, and that's perfectly illustrated in this chart. As you can see, the gold line at the bottom was QE1. The green line here was QE2. The blue line, which was, of course, unlimited quantitative easing, was QE3/4. And it's hard to tell from this chart, but this went over years. This went over 3 to 5 years for all of these programs. Now let's look at the red line, which is COVID-19 QE. And this chart's old, but it shows still that in a very short span of time, literally only days, the Fed instituted more QE than it had over years post 2008. It gives you some idea of not only the degree, but the rapidity of this program, how quickly everything has happened. And that wasn't the end. The Fed's QE infinity was immediately supplemented by trillions in stimulus spending, including helicopter money that wasn't dropped from helicopters, but simply directly deposited in voters' bank accounts. Now, here's a chart. This chart comes from Murin Bield and Associates. I highly recommend their Gold Monitor program, subscription program. We actually sell it on the Gold newsletter website. Great work done by Martin Murin Bield and his team. And as you can see in this chart that they've produced, the red is the stimulus program so far authorized by the U.S. Congress. The blue is all of the stimulus that was authorized by Congress in the post-2008 recovery efforts. As you can see, before the same amount of time elapsed for the post-2008 efforts, the U.S. stimulus programs for COVID have already dwarfed anything done before, and they did it within just days. And this is just the first payment on the stimulus programs. As everyone knows, they're arguing in Congress right now for step 2 of the stimulus program. And rest assured, it's going to be another massive injection of money, newly created debt. They're just arguing about the size or how enormous it's going to be. It's going to be big, and it's coming up. And just as an aside, I think that's one of the reasons why gold has taken off over the last couple of last couple of weeks. Gold and silver is that they're anticipating this next round of headlines, this next round of stimulus that's going to hit the U.S. economy. So what's the result of these stimulus programs so far? Again, this is just the initial stage. Exploding federal debt is up over $500 billion over just the last month. This chart I didn't bother to update because it's only a couple of hundred billion out of date. It's about a week and a half, 2 weeks old, and it's already 200 billion out of date. So it's an amazing amount of debt. Now, if you look at the bottom right, the federal debt to GDP ratio is over 132%. Anything over, say, 70 to 80% is a warning sign, and it inhibits growth of an economy. We were hovering around 103 to 105% for years post 2008. And now, in just a matter of a few weeks, we've exploded to over 130% of GDP, debt to GDP. So what are the implications of this massive debt load? Well, frankly, it's ultra low interest rates and forever due to the costs of servicing the debt. Simply put, the debt is so large now that we cannot afford to have any meaningful interest rates, any real interest rates adjusted for inflation, actually, that are positive. Because if there are positive real interest rates, then the cost of servicing that debt would swamp the federal budget. Let's take a look at how this works. This chart goes back to 1980 and tracks the effective federal funds rate. And of course, the gray bars are sessions. And what you see here is that the Fed, since the 1970s, has had one prescription basically for every economic slowdown in the US, and that's to lower interest rates. And as you can see, every interest rate cutting cycle has had a bottom that I've marked in red. And those progressive successive bottoms are a simple stair step down to the low achieved of 0 post 2008. If you go beyond that, then you can see where we are now. In this last line, we're not there. I'm really projecting that, but that's below 0, that last red line. Simply put, the Fed has lowered interest rates with every successive slowdown in the economy. And then when they tried to normalize rates, they were never able to even get back up to the midpoint of the previous cycle. The highs never reached the highs before, the lows never reached above the previous lows. Just a successive stair step down, lowering interest rates until they reached the basement, reached the foundation post 2008. And now the next step is into the basement. So if they're going to do something, if they're going to continue this trend, they're going to go into negative interest rates. Now, they've said that they won't do this. They say it doesn't work. They say it's something they're not considering. But if you carefully parse their statements, they have not ruled it out. And that's where the trend goes. So if we look at negative real rates, there we go. If you look at negative real rates, you know that negative rates are very bullish for gold. Whenever we have a period of negative real rates, gold always responds. Now, if we look back at this chart from Incrementum, our friends at Incrementum who do the In Gold We Trust report, great report they produce annually. This shows that effect of how gold loves negative real rates. These blue shaded areas indicate periods where negative real rates maintained. This gold line is the gold price. And as you can see, when we've had periods of negative real rates, we've had a really buoyant gold price. Gold prices generally rise when there are negative real rates for a number of reasons that are obvious, but gold doesn't provide a yield. So when rates are actually negative on a real basis, that negative aspect of gold essentially goes away. And it also indicates a period of monetary expansion, which of course is bullish for gold. So let's take a look back at that 2008 period and see how it perhaps, if it doesn't repeat this time, how it at least rhymes. Now, this is a chart of what gold did during and after, immediately after the 2008 financial crisis. As you can see, we had tremendous volatility, big sell-offs, tremendous sell-offs downward as people raised money to meet margin calls. They sold anything they could. Gold was available to be sold. It was the piggy bank to be broken into. So gold was sold off, and then it would bounce right back up. Then it would sell off, then it would bounce back up. Over a period of 5 to 6 months, we had incredible volatility in the gold price. But then this fear, this uncertainty in the middle of the crisis turned to greed as investors started to appreciate the unprecedented monetary easing, the unprecedented stimulus efforts that were being done post-2008, post the financial crisis. So this unprecedented monetary stimulus was hitting the economy, was being enacted, and investors saw what that implied, and they started buying gold. So from the lows in late 2008 to the highs of eventually $1,920 in the summer of 2011, the gold price nearly tripled in just that fairly short time frame. So let's look at what's happened in this crisis and what the metals are doing. This is a 6-month chart of gold. And you can see we have that sharp downward spike as the COVID crisis hit and people began to understand the implications, potential implications of this pandemic. As you can see, that spike downward, that period of volatility, whereas it lasted 3 to 5 to 6 months post 2008, it lasted only a few weeks, even days in this crisis. Again, and a theme I'll keep returning to, everything's accelerated in this bull market, in this crisis. Every time has been compressed. Everything is happening more quickly. So we had that illiquidity-driven sell-off, the bounce back, and then we traded sideways for a while. This was from about mid-April through mid-June. We traded sideways to consolidate that first massive run-up, which was very impressive until we saw this run-up in July. And there you see at the end of that chart how we just have had this tremendous run-up going upward. Now, this has actually been too quick for even the mining stocks to keep up with. And that's something I think we'll address later on in our further presentations with the companies. But we have an opportunity now, I think, where we have much higher gold prices and these mining stocks are starting to return to value levels. So let's look at where gold is and kind of the setup for the gold market right now. This is a very long-term 14-month stochastic. As you'll see in a moment, I typically look at a 14-week stochastic to see what the momentum indicators are over the intermediate term for the metals and for other commodities. But the 14-month stochastic shows these broad, big trends, these mega trends in whatever you're looking at, whatever asset class you're looking at, and in this case, gold. If you look back in the late 1990s, you see a few false starts in a bottoming period. And then we went up with a long period from 2001 to 2011, where the stochastic remained very high, showing that we had maintain consistent upward momentum, which is represented on the price chart by that big, huge, long sweep over many years to the price peak in 2011. If you look at the bottom here in recent history, if you look from 2011 through 2015, you see again some of these false starts, even from 2015 through 2017 and 2018, another kind of a false start, and then the momentum indicator, this long-term momentum indicator, went back down. Now we're back up. So this is duplicating the pattern that we saw at the beginning of the last major gold bull market. And the implication, of course, is that we may see something very similar here, a multi-year run that will take the gold price up many times over. So drilling down, focusing in a bit, let's look at the 14-week stochastic for gold. And here you see that it's up again at a very high level. And what I like to point out here is that we had that downturn and then we came right back up. It never really got back down to the lower levels or that key 20 level. It never really sold off and showed negative momentum for very long. And if you look back in the early 2000s, that's the kind of pattern we had where it maintained. We'd have short drops, but it would stay elevated. And we had rounded tops in the stochastic at higher levels. So that shows that we had maintained generally upward momentum in the price. That's the kind of pattern we're looking for now, and it's the kind of pattern we're getting right now. And we can see here the dollar index. The dollar's been very weak, and it's kind of a mirror image of gold. It's actually down and dropping. Now, I don't think we need a weaker dollar to power gold higher in this environment. I can see the dollar actually acting at some point as a safe haven in the days ahead, and as we get some of the repercussions of these extraordinary monetary policies. But it doesn't hurt. And that is another factor that I think is helping gold right now on this extraordinary run it's had in the short term. But let's look beyond this. Now, I don't show the silver stochastic here just for a lack of time, but it rest assured it duplicates or it parallels what gold has done, but to a much greater degree. This is something you won't see many people talking about, and that's copper. You can see down here at the lower right, the stochastic is firmly in bull market territory, showing strong upward momentum for copper. Copper is in a bull market stance. This is something people aren't talking about as much perhaps as they should. I had expected, if we look back on past experience, the time to buy copper may be a year or so down the road. Instead, it's more like a month down the road from when gold really started moving. Again, everything's being compressed. So let's look at the next thing that I found very interesting. I noticed this the other day, that the stochastic for the Thomson Reuters Broad Commodity Index is also in a buy signal, also showing strong upward momentum. This shows that very quickly, this move in the metals is expanding into a broader commodity-based bull market. Again, much more quickly than we had expected, much more quickly than we had experienced in previous bull markets. So the bottom line is a new metals bull market is currently in progress. And this chart illustrates it, I think, very well. This is the MACD chart for gold, but what I want to point out or have you focus on is the top panel showing this broad saucer-shaped bottoming pattern in gold. If you look at the left, that shows the latter part, or shows that 2008 to 2011 run. Even if we only duplicate that part of the bull run post-crisis from 08 to 2011, again, that nearly tripled gold's price from the bottom of around 700 to the top of a bit over 1900, nearly tripled. Our bottom in this case is around 1050 to 1150. If we have a similar run higher, from those lows, then we're talking gold prices well over $3,000. That's the kind of potential that we have, and those are the kind of targets we need to look at as gold soars above 2,000. So that's it for my presentation. I am Gold Newsletter, goldnewsletter.com. I am the New Orleans Investment Conference, neworleansconference.com. That's in October this year, and you can follow me on Twitter.